let me rewrite this over here in the middle and kind of go through and show you how the debits and credits work with the accounting equation, okay? So the first one we have is we have the assets, right? And they equal what? Liabilities plus stockholders' equity. Now, they talked about something called a T account. And a T account is basically where we're going through and we just basically do this. A T account is really a ledger, which we'll talk about in one of the later chapters, but it's where we go through and record the transactions that are going to occur in that account. Now, we have something called a debit and a credit. And people are always trying to say, well, which one means increase or decrease? Or what? They don't. What they mean are just left and right. I think they're actually Latin or some strange language for left and right. So debits are always on the left. Credits are always on the right. Okay? Now, the reason you need to know that is because when you go through and you post a journal, you're going to have to record these accounts, each of these line items like accounts receivable and cash, or what we call accounts. And transactions that affect those accounts are going to be put into them. You're going to have to show if they increased or decreased those accounts. Well, assets are always increased by doing a debit. Why? Because whoever started this decided assets should start with a debit, I guess, okay? And then that means that then the credit is going to be a reduction in assets. I think I have this here. On the other side, you have liabilities. Liabilities are always increased with a credit. So if you want to make an increase go up because you owe money to somebody, you're going to have to record that liability account with a credit. On the other hand, they go down with a debit because when you pay them, they're going to make them go away. You're going to do a debit. We're going to walk through some transactions. Maybe it'll make it a little easier. Stockholders' equity is the same way. It's on the other side of the equation, right? It's on the other side of the equal sign from assets. So anything on a stockholders' equity that's going to increase stockholders' equity is going to be a credit. Anything that's going to decrease stockholders' equity is going to be a debit. And that makes sense if you think about a simple transaction. Let's say we're going to go through and what's the first one they have here? Investment by stockholders on the bottom of page 15. Okay. If you go over and you look at the top of page 16, they talk about the change, and they say that assets went up by $15,000, right? And then stockholders' equity went up by $15,000. Well, what they mean is that when you did the journal entry, you had a journal entry for cash, and you did something look like this. You had a ledger, which has a debit and credit column. You wrote in cash, and you put a debit for $15,000 because assets are debited when they increase. Then you put stockholders' equity, and this would have been a common stock, would have been the type of account it was in. That's a stockholders' equity account. That would have been credited because you increase stockholders' equity with a credit. Your debits and credits always balance out because we want to make sure that these two sides are equal, and if we don't balance, then we know that we have some sort of a mistake in our accounting. So you're always going to have a debit and credit balance equal. You might have 3 credits that equal to 1 debit, so they don't have to be exactly the same number, but the two sides of every transaction have to report. So every time we have one of these transactions, we're going to be doing a journal entry. Now, that's the major accounts. There's also some other accounts that we do when we sell things, where we pay expenses and we receive revenue. And those accounts are over here on the stockholders' equity side. Let me kind of show you how that works. We have revenues, and then we have expenses. And the same thing happens here. We have debits on the left, credits on the right. So when we go through and we want to show an increase in a revenue is when we've sold something. So we sold something to a customer. Well, we're going to show the increase in that revenue as a credit. And the reason we're going to do that is because these revenues and expenses all increase the value or equity of our company. So we're going to go through and ultimately these are both going to be included into our stockholders' equity account. So if I sold something, does that increase the value of my company, the equity of my company? It does. So the credit here is going to increase the credit up here when it gets moved in. So the value went up. Makes sense. You don't see this very often, but if you decrease a revenue, it's going to be done as a debit. Expenses are a little weird, though. Everybody gets confused with them. Because the way you increase an expense is you do a debit. So then what happens is people say, oh, expenses are like assets because they both have debits. No, they're not. Okay, that'll confuse you. Expenses are where we've used up an asset or we've used up something, we've incurred some cost of doing business. This is going to ultimately be included up here in my stockholders' equity. Well, if I spend money, say I pay wages, so I pay $10,000 to people, that's an expense. I debit salaries and wages expense for $10,000. When I combine this and put it up in here, it's going to go up here as a debit. What happens to stockholders' equity when you debit it? It decreases. Did paying that money to the employees decrease the value of your company? It did, because cash went out the door. So the expenses are debited not because they have anything to do with assets. They don't. They're debited because they're representing a reduction in the value and equity of the company, just like the revenues represent an increase. On the other side, you would have a decrease if you had an expense, would be with a credit. Okay? So it's really important to understand how these work, because you have these 5 types of accounts: assets, liabilities, equity, revenues, and expenses. You need to understand 2 things. When you see a transaction, you need to say, oh, that was a revenue account, or that was an expense account, or that was an asset account. So you need to be able to look at the transactions and identify them. Then you need to ask yourself, did that account increase or decrease? And then you go, oh, it was an expense account, it increased. Well, then I need to do a debit, because you know that expenses are increased with debits. If you understand how these 5 accounts are increased or decreased with debits and credits, you will save yourself so much time, because people will try to go through and read the book and memorize which accounts get debited and credited for every different transaction. And your head will explode, because there are too many accounts and too many different types of transactions to memorize. So after you get about 15 of them memorized, then your brain just shuts down. You can't remember them. So don't try to memorize them, analyze them. Ask yourself first, when a transaction occurs, am I talking about an asset, a liability, an equity account, a revenue, or expense? Usually it'll be 2. So maybe you bought an asset, okay? Or sorry, maybe let's do it this way. You received a payment from a customer, okay? They bought something from you. So you know revenues went up because that's a sale, and you got cash, so you know an asset went up. So you say, oh, okay, well, revenues went up, what should I do with it? I should do a credit. And an asset, cash went up, what should I do with it? I should do a debit. Hey, look, my credit and debit's equal. Yay. You don't have to memorize it, you have to analyze it, okay? You will save yourself so much time. So that's my first secret on understanding. Right there, hopefully, that gave you enough that this whole session was worthwhile. The other thing you might want to keep in mind, there's something we call normal balances. That means that the accounts have a balance that usually most of the transactions are either debits or credits. So with an asset, this is the normal balance. It's an asset, it's a debit. So normal balances are here. On liabilities, normal balances are on the liability side. I'm sorry, on the credit side. And in stockholders' equity, normal balances are also on the credit side. That doesn't mean that we never have transactions on the other side. It just means that most of them are going to be on the normal balance side, and at the end of the period, if there are balances that end because you have a transaction and goes all the way down, you add them all up, you'll normally have a balance on that normal balance side. Expenses normally have a balance on the debit side. And then revenues have a normal balance on the credit side. So hopefully that'll give you a little bit of information to help you be able to understand how the debits and credits work. Kind of a jump ahead on chapter 2 a little bit.